Hey guys, my name is Matthew Spazziti here with New Millennium Wealth, and welcome back to the channel. I hope you guys are having a great day today, and welcome back for the fourth episode of the weekly market analysis. So today I actually found a number of options. I actually found 4 different chart analysis opportunities, if you want to call them that. Basically just me practicing my analysis on the markets. And the very first one that I found was one here. It was a potential opportunity on the euro pound, and if we want to look at it here real quick, ultimately, actually, let me go ahead and pull it up here on a chart real quick. Euro pound. All right, here we are. So ultimately, I found this is a strategy where, if you recall, I took a smaller trade on this, or I took again, it was a hypothetical trade, for analysis purposes and educational purposes, just for the fun of it. I'm practicing my analysis, trying to get better and better at it every day. And I took one earlier where I measured from this swing low right here to this swing high. And basically, I was under the impression that this was basically the market was retracing and everything, and we were going to hit the 618 and rally off of that. Unfortunately, we ended up having a complex pullback, like we've talked about in the past in previous videos, and now we look like we're going to continue lower. Now, whether or not this is actually going to continue lower and stop me out again for a second time, and this is actually some kind of a more short-term, a longer short-term reversal, or what, I'm not entirely certain. But I do think that there is a good chance that this could just be a complex pullback and that the market's going to retrace and effectively rally from here. Now, I didn't use this as justification for taking this trade, but as you can see here, the market, it was oversold by a good 6.23 on the relative strength index, which basically means that there's a good chance that we could get a rally here. Now, what could that mean? Well, first and foremost, it could mean that the market could simply come up here, have a bit of a retracement, and then go ahead and get rejected from there and then continue on in the direction that it already looks to be going in. So that could possibly happen, or the market could stair-step its way all the way to the top, all the way to up here at 90.51.3. Ultimately, I don't really know what's going to happen here. Today, I forgot to mention, what I actually did was I used my fib retracement tool for this bigger extension point, which in reality, if you look at the overarching trend here, let's go ahead and draw this in and I'll show you. Swing low to swing high. Okay. And then if we actually wanted to look at here, if you really shrink up the chart and everything and you look at the overarching trend, this was really the consolidation that created this big bullish move. And in reality, I mean, if we look at the daily chart here, what the euro pound is really doing is just, again, more or less just consolidating more so than anything else. Yeah, we did create new lows here, but then we came back up here to retest, and now we're kind of just consolidating sideways, not really knowing where to go in terms of market direction. So we were bullish, since the early 2000s, and we ended that bullish phase in 2009. And in reality, we've kind of just been going sideways. We went sideways, we went down from 2013 to 2015 for 2 years, and then we went from 2015 to about 2017 is when we peaked. So where the market's really going to go is anybody's guess. I'm kind of thinking that because we created this high right here at 97.71.4, and that is way higher than here, we definitely closed above here, I'm kind of thinking that overall this could very well be bullish. That you can see here, we had our initial low, or we had an initial high, initial low, a new higher high, and a new higher low. So in reality, long term, I think this could be a bullish trend, and we could be heading higher. But in reality, when we're really talking about things that are that far out, it's actually very difficult to predict with any kind of real accuracy on it. So which is why I try to stick to the short term overall. Just market conditions are very, very they can be kind of loose, if you want to say that. Just sometimes market conditions can change on a dime. So this is the euro pound trade on the hourly chart. I drew the Fibonacci retracement level retracement tool from the lows here to the highs here, and this was our 618 retracement. Now, again, we could very easily get stopped out, as I said in the description of this post, but you know, for now, it does look like it could be a good opportunity. If all this is simply a 2 drives complex pullback, then we could we could probably get involved here and then go ahead and rally from there. Now, I will say that when I came to this, I didn't really put my hypothetical entry on earlier, so unfortunately I did miss it. So if this continues lower and it doesn't touch the yellow line again, then I'm not going to be able to get involved in this, and my analysis was obviously wrong, but at least I don't hypothetically lose money, which, you know, is really neither here nor there. This is just for practice purposes and whatnot. However, if we do rally from here and we end up coming back up here, we're going to hit the entry point anyways, and then we'll end up, you know, hypothetically making money, which would, you know, even though it's not real money, it makes me feel good. So that's great. All right, so as you can see here, this is pretty straightforward, just trend continuation pattern, where the market basically had a new lower low right up, or the previous lowest low was all the way up here, had a triple bottom, or at least it retested 3 times this current price level of 1.78630, and eventually the market just rolled over and closed and made a lower low, lower close, closed below there, therefore violating this structure low, and now has started to retrace into the 618 retracement. Another interesting thing that caught my eye out here, and again, I don't really use the relative strength index in order to determine whether or not I get in or out of trades, but it is nice when my trades have some confluence with the relative strength index. And right here we have an overbought situation of 94.40, which is a pretty large overbought condition. And in this situation, basically this would mean that ideally we would hopefully see a sell-off here, and we would see the market basically sell off and hopefully continue in the current trend, the current bearish trend that it's been on. Unfortunately, though, the market, since it put that in, and sometimes the relative strength index is a little delayed, but so far since then, as you can see, the market has simply just rallied even higher, making a new higher high, higher close from the previous higher high. Now, we're still within the trade, we're still within the zone here, or what I like to call the kill zone, of basically previous structure. So it is totally possible that in reality we could lose steam up here, that this overbought condition could mean that we just haven't really sold off yet, but that we will, and it's a complete possibility that may happen. It's also a complete possibility that this overbought condition, since it occurred right here, basically this little tiny retracement was all the overbought condition was really identifying, and sometimes that is the case. Sometimes you can get oversold conditions or overbought conditions that really don't result in a new direction, if you will, of a market reversal. Sometimes it's just sometimes they just represent little tiny retracements in the market. So, but overall, this is a pretty standardized trade here. You know, there's nothing too special, and ultimately, I think there's a pretty high chance that it'll continue to roll over, but we'll just have to wait and see. Obviously, just because the relative strength index says that it's overbought doesn't necessarily mean that the market will continue on in its bearish trend that it's been going on in for quite some time. We also had a very serious oversold condition over here, where the market had come down all the way to 3.67. That's a very serious oversold condition. So this could have identified a full-on reversal. But I don't know. All in all, guys, it's just something where we're just going to have to sit on our hands and wait. You know, when I actually start backtesting this particular strategy, something I might actually do with the relative strength index is I may, in fact, try to trade the strategy. I may put that in the trading plan where I have to have a overbought or oversold condition on the relative strength index before getting involved in a particular trade. So not only do I have to see the market making a new lower low, lower close, thereby violating previous support, and then I also have to see the market retracing back up into a 618 retracement, then I need to see an overbought condition on the RSI before I basically go and short the market. So that might be something I might end up doing, integrating that basically into my trading plan just to see whether it actually filters out non-profitable trades and lower quality trades, and so that would give me the ability of basically being more profitable. But in the end, I'm just going to have to go ahead and integrate that in the trading plan and see how it goes. Now, one thing I probably will do, though, is I will more than likely not integrate it right away. More than likely, I'm going to go ahead and probably trade the strategies without the RSI and see what the performance looks like. And then I'll probably retest the strategy with the relative strength index integrated in the trading plan and see if it makes any difference or not. So that's basically my analysis on the pound Aussie. Funny story, actually, when I originally recorded this video, I was saying that I was looking at the pound Aussie, but what actually happened was I clicked on the pound dollar. And for whatever reason, I was actually giving my analysis on the pound dollar, but the whole time I was saying it was the pound Aussie. I'm not sure how I messed that up so badly. But so this is a new video that I did, a little clip that I did to basically insert in the original video. That being said, let's go ahead and start moving into the other two trades. We're really kind of fascinating, and I wanted to give a bit more time to and actually talk about. So here, actually, let's go ahead and cover the pound Swiss real quick. Pound Swiss was kind of interesting here. All right, pound Swiss. Here we are. So this is actually a trading opportunity where basically it looks like another just a normal trend continuation opportunity. Here is an issue that I have with it. Now, granted, we were overbought by 90. It was what, 94.45. That's a pretty big overbought condition. So the market is going to continue down here with regards to the relative strength index, as you can clearly see, and ultimately, this could be a sign that the market's going to continue to fall, much like it was here. The relative strength index went overbought at 86.37, and then it continued on making a new lower close right here. So this could very well be a situation where that happens. Not to mention, this was a double bottom right here, which is usually a sign of a reversal. But if I know anything from backtesting double tops and double bottoms, then I know how inconsistent the double top and the double bottoms are simply by just them forming. If you don't have filters that filter out double bottom and double top trades, and you don't control your risk really well, you're basically going to bleed out money if you only trade double tops and double bottoms. They're not very consistent patterns. I know that from experience because I'm backtesting a double bottom. I'm backtesting a double top, double bottom strategy currently, and it's not very consistent. Now, granted, it's also not consistent with regards to the trades that I'm taking currently because my entry is so low that by the time the market actually hits that entry, it's going to stop me out anyways in most cases. Now, if I was to trade it differently, the consistency would be a lot higher. But overall, though, double tops and double bottoms simply just are not that accurate of strategies. They don't win very often. Not to say that they don't win, and not to say that they're bad strategies and you shouldn't backtest or create a trading strategy off of them. That you absolutely can. I'm just saying that they don't win that often. Okay, that's all I'm saying. Now, here is a little bit of a difficulty for me. I kind of looked at the overall chart. And what I see is that the most significant retracement is all the way back here. So I naturally wanted to do swing high to swing low with the fib retracement tool all the way back here. And I wanted the market to come up here and hit the 618 retracement. Now, this is something that could very well happen on this particular chart, but it's not necessarily guaranteed. But who knows whether it's actually going to happen or not. Although it can happen, doesn't mean it will. And if I do get stopped out, I will be looking for another entry opportunity here up at 123.93.2 to see if we can see if this is basically just a bigger retracement for this overall extension that was created here. But as of right now, I decided I'll take the small trade here first before I basically go off and hold out for that bigger trade. And this may work out perfectly well. And if it does, that could be within my benefit. But you see this double bottom, if this double bottom works out well and actually does end up working out, then it could very well retrace well into the 618 retracement level with regards to this overall extension right here. So we're just going to have to kind of wait and see what happens, and I'll definitely be giving you guys an update on what happens. I'll be posting updates on TradingView when these trades come to fruition. So if you're not checking that out, go ahead and check out those trades that have already basically, where the market's already decided what it's going to do, and check out those posts, because I do updates all the time on my posts and actually try to give you a short synopsis, nothing too detailed, but just a short synopsis of what more or less happened. All right, moving on into the final pair that I found today, which was the dollar Aussie. Now, you may find that to be a little weird of a currency pair, because normally when people are talking about anything with regards to the US dollar or the Australian dollar, they're talking about this one. This is the Aussie CAD, I'm sorry. The Aussie dollar. This is the one they're really talking about, isn't it? So most of the time, most people are not talking about the dollar Aussie. They're most of the time talking about the Aussie dollar. Australian dollar versus the US dollar. And more or less, this is the more popular pair of the two. They're basically let's be honest, they're the exact same charts, they're just inverted. So right here, as you can see, the Aussie dollar is bearish. We're definitely going down here. Whereas the dollar Aussie is bullish. We're definitely going up. But here's a situation. I actually already had a trade on the Aussie dollar before. And it was a trade here where I basically measured my fib retracement tool. I drew it from the swing highs up here to the swing lows down here. I got my 618 fib retracement. The market came all the way up here, touched it, and then we also went overbought here. And we were overbought by 91.67, which again is not the biggest overbought that we've seen here on this channel, or for me personally, it's not the biggest one I've seen, but it was still overbought by over 80. So my limit is 80 right here, and that is usually an overbought condition. Now, we also went oversold here fairly recently on July 22nd and July 23rd. Now, both of them were both of them were not as low as each other. One was a little lower than the other, and it was oversold by about 11.17, and then it went oversold again by like 13.54. Now, what does this mean? Now, which is the market going to do? Now, this is one of the reasons why I don't actually base my trades completely off of the RSI, and why I really don't even factor the RSI into the trades that I take. Again, if there's confluence, then that's great, but it's not something that I actually need in order to get involved in a trade. And here's the reason why. You could get two conflicting signals. So we had an overbought condition right here. We fell. Now we have an oversold condition right here. We actually put in two oversold conditions, and now we might rise again. But the RSI puts in lots of these reversal signals, and it doesn't necessarily mean that the market will reverse. Right here, we had a very large oversold condition at 880, and that was all the way back here. That happened a little bit back here. That was on the 23rd of April of this year. We kind of came down. We were oversold, and then we made a little spike. We were slightly overbought, and then we fell again. But you see, this oversold, if you had gone long right here, sure, the minute this happened, if you had gone long somewhere around this point, right? Well, first and foremost, you would have lost money, and then you would have started to make money. So sometimes the relative strength index, it's a great index, it's a great indicator to kind of identify, to add justification for taking trades, or to just kind of add more confirmation, I guess. But in the end, it's not something you want to solely base a trade off of. It's not always accurate. But we do have, and sometimes you get conflicting signals like this. This overbought condition could easily just be a small retracement that could end up rallying all the way to stop us out. Or it could rally a little higher, and then fall again. I mean, who knows what's going to happen. Now, the interesting thing about these two charts is that I have effectively taken a hedged trade. I've effectively taken engaged in a hedging trade where I am short on the US dollar, on the dollar Aussie, and I'm short on the Aussie dollar. Now, here's the problem with that. The problem is, even though I'm short on both currency pairs, you probably think, okay, well, that's fine. Well, no, because both currency pairs are inverted. So they're the complete opposite of one another. So on the Aussie USD, I'm shorting because I see here that we've had a retracement, and I'm not sure if this is just a complex pullback, although it does appear to look that way currently. And we don't really know if this is going to be a complex pullback until it decides whether it's going to continue to extend higher. Then I would say this is probably more of a reversal than a complex pullback, or if this is going to continue to roll over and continue the bearish trend that the Aussie dollar has been in for quite some time now. Now, here's the ultimate question. What's going to happen? You know, why am I involved in two trades that are completely inverse? Well, first and foremost, I decided that even though this is even though this is a situation where it is opposite, I figured, hey, it's not really going to hurt that bad. You know, if I could be right in one instance and wrong in a completely different instance. Or there's a chance I could be right on both, and my analysis is correct in both circumstances. That could also happen. But it's also a hedge. Now, one trade is clearly larger than the other. The Aussie dollar trade is clearly the larger trade than the dollar Aussie is. But overall, there's still kind of a bit of a hedge. If you don't know what a hedge is, basically it's where you're taking a risk and then you decide to take another risk in another area where that is basically in the opposite direction of the risk you initially took. Okay? So here's what happened. If we had just done this, then basically the trade that I took would have been this one right here. I would have gone swing low to swing high. I got my 618 retracement. I would have gone long, and I would hold for 70 all the way up here till 70.81.7. I'd put my stop loss below here, below 69.093. And that's basically what this is. So I'm taking on this chart, even though it's a shorting pattern, that's just because the charts are inverted. Basically, I'm taking a long position in the Aussie dollar and a short position in the Aussie dollar. Conversely, if I had done that here, then the position I would have taken would very clearly have been one of a bullish nature. On the dollar Aussie, these advertisements keep popping up. They're crazy. They're driving me nuts. Let's see here. All right, where did I get 70.63.9? I guess it would be different. It would totally be different. Okay. Let me see here. I'm pretty sure my measurements are correct here. Well, I think that's right. So basically, if I was going to take the trade I took in the Aussie dollar, then that would be right here. That trade would be this trade right here. I'd put my yellow entry line right here, and that is basically where I would be taking it, and then I would be holding, I would be buying long and holding all the way up here to 146.33. Okay? So this is a situation where I would be short here, but I'd be long here. And that's okay. So this is where this is a hedge. You see, you're taking two completely opposite trades in the opposite direction. Now, here's what could ultimately happen. Either A, I'm absolutely correct in shorting the Australian dollar, the Aussie dollar, and it's just going to continue lower. If that occurs, then this trade will continue higher. Again, they're inverted. When the Aussie dollar goes lower, the dollar Aussie goes higher. So if the Aussie dollar goes lower and ends up getting me out of the market for my target for whatever and ends up making me money, then the dollar Aussie is going to stop me out. Now, if the dollar Aussie ends up retracing, making me money here, then the Aussie dollar, I'm not necessarily going to get stopped out unless it continues higher. So that's why I said previously, like, that there is a potential for the Aussie, for me to make, to be correct on both of these. In the event that these oversold conditions end up causing a spike in the market, in the event that that is an accurate signal, and it's a signal that the market, I guess, respects in a way, and it accurately predicts that people are going to end up, buying more and more and more. If that actually were to occur, then we would see the market come all the way up here. Now, if this happens and the market comes all the way up here, not only will I make money here, because basically the market will be moving in this direction on this pair, I'll make money on my dollar Aussie trade, but I will also won't get stopped out right away. And if it continues to rally and then goes overbought or whatever, and the market basically fizzles out up here, just loses steam, and it starts to continually step down, 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 then I'll make money on both pairs. So there is the potential for me to make money on each pair. Now, you're probably asking the question, why do you have two currency pairs that are basically the same but inverted? Well, to be completely fair with you, I wanted to get a different perspective. I wanted to see the exact same chart but inverted. And on top of that, normally, and this is not always the case at all, but normally what you have is you tend to have currency pairs. The initial currency is actually stronger than the secondary currencies. So the CAD yen, 1 Canadian dollar goes into 82 Japanese yen. So the Canadian dollar has the higher exchange rate. It exchanged for more in the yen than what the yen would exchange into the Canadian dollar. So if you were to live in Japan and you were getting paid in Canadian dollars or British pounds or US dollars, you'd be making more money. 135 yen for 1 British pound and 108 yen for one US dollar. Granted, you'd have to be living in Japan, and you would also have to be getting paid in that currency. And simply because you're getting paid in that currency doesn't necessarily mean that the cost of goods are going to be cheaper for you. Sometimes a good in Japan, even though you have the exchange rate in your advantage, doesn't always mean that the product you're buying is cheaper. Sometimes, although the price tag may look more expensive because it's converted into yen, when you convert it back into your home currency, what you would need to do is you would need to look at that same product or a very similar product in your hometown where you're from and see if it would actually be cheaper from there. So if it's a stick of deodorant or cereal or milk or even fruit, you would have to basically compare prices that way. Simply because the exchange rate is the way that it is does not mean that it is more expensive or cheaper inherently. So keep that in mind when it comes to currency. That's a small economic lesson there for you. Back to this, though. So I thought this was kind of an interesting situation I wanted to make you guys aware of and show you guys. I know it's a little weird switching from two charts, the dollar Aussie and the Aussie dollar. And I know it's weird, many of you are probably saying, why didn't you just take the opposite trade on one chart? Why did you take it on two charts? Well, because I didn't see it. Okay? I didn't really see. I was already involved in a trade. And once I get involved in a trade in a particular currency pair, I don't look for alternative trading opportunities in that currency pair. Maybe I should, but I don't. So because here, even though we broke out and we made a new structure high right here, a new higher high, and we closed above previous highs right here, even though we did that, to me personally, I don't actually see this. I didn't really see a buying opportunity here. Whereas on the dollar Aussie, I actually looked at here. I'm like, whoa, hey, I had a yellow line here. I had my fib retracement on already. I had already been looking at it a few days ago. And I noticed, well, we made a lower, low, lower close right here. And then we came up and we barely touched my entry point. We put in oversold conditions right here. Overbought conditions right here. Man, I almost did it again. Or I did do it again. We ended up putting in overbought conditions right here. So on the RSI. So, I was thinking that, oh, hey, I saw it in that way. But when I was looking on the Aussie dollar, I just didn't see it that way. So that's basically what. But it'll be very interesting to see how these two charts end up working out. That being said, let's go ahead and I wanted to kind of give you guys an update on what was happening with Bitcoin here. So basically, Bitcoin is just continually moving lower. It's not. It's really looking like it's going to be the secondary option here, where it's going to continue lower, maybe have a little bit of a pop up here, and then go ahead and continue on with the bearish trend that we established here back in June 26th of 2019. So I don't think the market's actually going to go ahead and get up here. In point of fact, look at this already. I anticipated it being up here like around this point, and now it's going to it's continuing lower right here. I was pretty sure that this was going to be the case, or at least I felt that there was a pretty high probability that that was going to be a situation, just with how the market was already kind of behaving. It was, you know, it was already kind of heading lower, and it would have been a lot for the market to get up here. Sure, it's absolutely possible the market could make a pop right here and get all the way up to the 618 fib retracement level. Absolutely possible that could happen, but odds are it's probably just going to continue on. We might not even get this little pop right here, but we might just continue bearish. And if it does, if you're in Bitcoin, prepare for prices in the $8,000 range, because that's probably what you're going to get if we continue lower. And in reality, guys, you know, that's just trading for you. And right now, Bitcoin is highly speculative. It's a very speculative thing. I actually really, really like Bitcoin quite a bit. I don't dislike Bitcoin in any which way, shape, or form. I think it's really cool to be able to put my money into a total digital currency and then be able to put it into a Bitcoin wallet, and then being able to download that wallet onto cold storage like a flash drive, and then basically go to Europe and then exchange it into another currency. I think that is really cool. I don't know. I just think the concept is really, really cool. I think it's a cool medium of exchange. You can buy things with Bitcoin today, but in order for it to really be adopted on a mass scale, you really need Bitcoin to be less volatile. Volatility is great when you're looking for speculative purposes, when you're trading or investing. Volatility is what you want. But even then, there is a point where you just have too much volatility. And when it comes down to Bitcoin, you don't really want volatility like this when you're looking to transact in it, like in a normal business deal where you're looking to buy, I don't know, eggs or milk. Retailers are going to be less likely to do that. I mean, let's look just real quick here. We're going to look at a daily chart. A daily chart will be much easier to get a better sense of this. I really don't want to delete my stuff quite just. Okay, so right here, the market opened today, or at least this candlestick started at $99,859.40. The market swung all the way up to $9,921.70, came all the way down to $9,536.80, which is a good, almost a $300 move in price. That's insane. And now it's all the way back up to $9,700, $9,716.40. I mean, guys, this is insane. I mean, this tiny move right here, you had $200 to $300 moves in one shot. Guys, if this is going to become a currency that is adopted on a massive scale, then it needs to have less volatility. That's just the truth of it. All right, guys, well, that's all I got for you today. So I hope you guys are really enjoying these videos. I'm actually really enjoying doing them. I'm really enjoying, showing you guys my analysis, coming in here in the market every day and showing you guys what I actually think is going on in the markets. I think it's a lot of fun. I hope you guys are enjoying it as well. If you guys enjoy it, make sure to like the video and subscribe to the YouTube channel. Also, hit that alert button in there so that anytime I post a video, you guys are going to be alerted the minute a new video is posted. Also, on top of all that, if you haven't checked out the website, if you haven't checked out the Facebook page, the Pinterest, if you haven't checked that stuff out, guys, please go check all that out. I got a lot of other stuff going on. I got a lot of other content that I'm producing, on the website. I've got tons of different articles, not just related to simply trading, although there are a few trading articles on there, and I'm posting new articles on there all the time. So if you guys are interested in any of that, please check that out. If you guys do all that for me, I'll see you guys in the next video. Know the risk, plan accordingly, have a great day.